Okay, why don't we start, everyone? Welcome and good afternoon, everyone. My name is Kurt Zimmerman. I'm a trust and estates attorney in Fort Lauderdale. I'm privileged to be the chair of the PAC and a board member at the Community Foundation in Broward. Welcome. Our topic today in our third PAC webinar of the season is a very timely one and something that I'm sure many of you are thinking about in your offices. And that is the impact of the recent congressional and presidential elections on our planning going forward. We're very privileged to have as our speaker today, Mitchell Drossman, who is the head of national wealth strategies and a managing director at Bank of America Private Bank. Our friend Penelope Blair, one of our PAC members who most of you know, will give Mitchell a proper introduction in just a few minutes. Penelope is a senior VP and private client manager at Bank of America Private Bank. So our thanks to Bank of America today. So now on to a bit of PAC business. First, I'd like to announce that Judy Bonavec has accepted the position of vice chair of the PAC. And as you know, Judy is a terrific attorney and a great person. And it's just good to know that the PAC will be in her capable hands at the end of this season, which will be around July 1st. So Judy, thank you for agreeing to do that. So our focus in the coming year for the PAC will be to bring greater diversity to our membership. Our 85 members now are predominantly from the eastern side of Broward County, which is understandable because so many of our offices are located in and around downtown. But we'd like to reach out and enhance our representation from other parts of the county. So there's geographical diversity, ethnicity diversity, all forms and fashions, just to broaden the reach of our PAC. This effort is really aligned with our PAC's and the Community Foundation's commitment to foster philanthropy to make Broward as a whole better. So we would like to represent our county as best as we can here at the PAC. So we'd appreciate your help in those efforts. So if you know of a fellow professional advisor who we should get to know, please introduce them to Mark Kotler, who will be speaking in just a moment. Mark is on the team at the Community Foundation, and he will reach out and make an effort to invite these folks that you introduced to us to come aboard the PAC, hopefully in the near future. So our next meeting will be the highlights of the Heckerling Conference on May 25th. And that will be a good opportunity actually to invite a friend, a colleague, a fellow professional advisor to come along as a guest and be introduced to the PAC. So now let's move on to the presentation today. There are a few ground rules. If everyone would just kindly hit the mute button on their Zoom, that would be great. And secondly, we will take questions at the end. And the best way to submit a question is through the Q&A button at the bottom of your screen. Not the chat button, but the Q&A button at the bottom of your screen. You're welcome to pose questions there, and then I will see them. And when Mitchell is finished, we'll have those teed up, ready to go. So now I'd like to introduce Mark Kotler, Senior Director of Philanthropic Services, to tell us what's happening at the Community Foundation. Mark?
Kurt, thank you so much. And hello, everyone. I'm so glad you could join us today. In line with what Kurt was saying about increasing the diversity of PAC, the Community Foundation ensures that all of its efforts encompass inclusivity, racial equity, and social justice. Two of our current initiatives illustrate this really well. Art of Community is one of the Foundation's 10 issues that matter, and it's a focus of our grant making. We believe that the arts are key to a vibrant community. Our goal is to ignite creativity, to fuel community pride, and connect people with each other by growing and sustaining the arts. Grants often support musical performances, colorful murals, arts education, cultural festivals, and others to embed the arts in more Broward neighborhoods. We recently invited Broward organizations to apply for a grant to address social justice and racial equity through the arts, specifically to enhance community or civic engagement, create dialogue and expression for social justice issues across different sectors of our residents, and to help build relationships around this issue. Nearly 50 grant proposals were received, requesting a total of $2.5 million. There is $350,000 to allocate to this important work. And we are really so grateful to our fund holders, many of whom are your clients who have created endowed funds to support the arts. Yet, as you can tell, the need is much, much greater than the resources available. So if you have a client who is passionate about the arts or elevating the social justice conversation, please connect them with us to learn more about this opportunity. So the second issue centers around economic independence. You may have already recently seen in the news about our launch of an exciting $1 million Be Bold Prize initiative. Before the coronavirus hit, nearly half of Broward's workforce lived paycheck to paycheck and was one emergency away from poverty. Now, the pandemic has caused unemployment to nearly double pre-pandemic levels. African American and Latinx residents have been particularly hard hit, worsening the disparities in our community. Without reliable employment, growing numbers of hardworking families are struggling just to put food on the table and to stay in their homes. Our community is on the brink of a huge spike in homelessness. The Be Bold Prize initiative seeks innovative, out-of-the-box thinking to get local residents back to work and as soon as possible. The Be Bold Prize is being promoted across the country in over 100 media outlets. We're meeting with potential sponsors who could be partners to join this project, and the interest has been tremendous. 68 organizations were on the info call just last week, and a Shark Tank-like competition awaits the finalists in May. The winning collaboration will be awarded $1 million to get Broward back to work, and we can't wait for them to get started. Well, let's get to today's presentation. And as Kurt mentioned, this highly anticipated expert speaker is here thanks to a big proponent of the Community Foundation, Penelope Blair. Penelope is the Senior Vice President and Private Client Manager of Bank of America Private Bank, and she is joining us now and will introduce our speaker. Welcome, Penelope.
Thank you, Mark, and hello, everyone. It's an honor to introduce Mitch Drossman. As mentioned, he is head of the National Wealth Strategies of the Chief Investment Office within Bank of America's Global Wealth and Investment Management Division. In his role, he manages and leads the wealth strategy advisors to provide objective insight to help the Bank of America Private Bank clients to align their financial and estate planning strategies with their goals. Now, Mitch works with individuals, families, closely held family businesses, family offices, and institutions. And he works in conjunction with our clients' tax and legal advisors to facilitate the wealth transfer, the business succession, which includes the post and pre-liquidity event strategies, the wealth structuring and estate planning needs that are often very complex and require customized analysis and strategies. Prior to joining the private bank, which was formerly known as U.S. Trust, Mitch was an estate planning attorney with the New York City law firm Proskauer & Rose. He also holds a CPA designation and was formerly with Ernst & Young. Mitch has served on the advisory board of Practical Drafting, which I'm guessing many of you will know is a highly regarded estate planning publication. He is a sought-after speaker and has been quoted in various publications, including the Wall Street Journal, Barron's, Forbes, Business Week, and the New York Times. He is a fellow in the American College of Trust and Estate Counsel. He is a current member of the Alumni Admissions Board at the Brooklyn Law School, and he has served on many different organizations, including the Association of the Bar of the City of New York, the New York State Society of CPAs, the New York State Bar Association, the UJA's Federation Trust and Estate Specialty Group, And many times he was on the committees for estate and gift taxation, chairs of income and taxation, and chairs of other things. And Mitch received his JD cum laude from Brooklyn Law School, where he served as editor of the Law Review. So as you heard, Mitch has done a lot of things and continues to do a lot of things. But the one thing he does not do is he does not provide legal or tax advice in his role at Bank of America Private Bank. So Mitch, thank you so much for being here and joining us today.
Great. Thanks, Penelope. Thanks, Abby, Kurt, Mark, and thank all of you for coming to join us this afternoon. There's the name of the kind of the topic we use, impact of on the elections of income, wealth, and estate planning, is actually a really broad topic. It covers a lot of jurisdictions. So I don't want to hesitate. I really do want to jump in. But if I were able to kind of sum this up, it's a presentation about kind of the questions that we are being asked from clients, and I'm sure that you are also being asked, similar questions, and then give you insight as we discuss with some of our lobbyists in Washington and others in our federal government relations group of what do we think that the outcome might be of tax legislation over the next, whether it's the next couple of months or the next year. I'd like to say that these are not predictions, rather they are forecasts. I'm not quite sure if there is a difference, but I will tell you is that when I hear the word forecast, I think of weathermen, and when I think of weathermen, they are often wrong. So if I am wrong, I apologize in advance, but it's far easier to make, I think, a forecast than a prediction. But I think we have a really good sense of how things kind of unfold in the coming months. I want to give you some insight also whether or not we see changes, if they would be made on a retroactive basis, date of introduction, or a prospective basis. So we'll cover estate taxes that will actually address not only the true estate tax, but a little bit about step up in basis, income taxes, Social Security taxes, and then we'll conclude and we'll take some questions. So I'm going to jump in and we're going to go, and Mark, thank you for advancing the slide. I think we're on a slide here. There's 2 pages here that are an overview of Biden's tax proposals. I'm going to zero in on the estate tax line for a moment, and then we're going to go and we'll talk a little bit later on some of the income taxes. So on the estate tax, is what we focus on here is one of the proposals that Biden has, which was probably the most specific but still a cryptic proposal about doing away with the step up in basis. And I say cryptic because I'm not sure what that really means. And it could possibly have 2 different meanings. It could mean what was enacted actually in 2010, which was a true repeal of the step up in basis and went to a carryover basis. Or it could mean what was proposed when Biden was vice president in 2015, and where President Obama then proposed that unrealized gains would be due on death if there was a transfer to someone other than a spouse or a charitable organization. So again, it has 2 different meanings, but both very important for taxpayers. We're not sure where this comes out. Let me just tell you a little bit about what the Obama proposal was in 2015, because that very well could surface again. The proposal there was, upon death, is that there would be no step up in basis, and in fact that there would be a deemed gain unless the assets were passing to a surviving spouse. That deemed gain, or surviving spouse, or to a charitable organization. So that deemed gain would be offset by up to $250,000 if there was a residence, so $500,000 between a couple rather. Or a smaller amount, I believe it was $100,000 for any other gain, and that could be, so it doesn't mean it's $100,000 of assets. It was just $100,000 of gain. We may see that, or we may actually see what we call a true carryover basis, where the assets don't get stepped up to date of death value and instead carry over to the beneficiary. And then when the beneficiary sells the asset, that would be a deemed gain there. We'll come back and we'll talk a little bit how that relates to some of the capital gain changes, because that is one of the biggest revenue raisers. And I think that there's a very realistic chance of something like this happening with some softening of this, because if it was really a true carryover basis, then it would expose a lot more people to a tax than are otherwise exposed to the tax currently, because currently you do get a step up in basis and there's a significant exemption, thereby insulating 99.9% of taxpayers. Okay, one other item that we'll talk about in a moment that's on this page is Social Security taxes and some of the proposals around that. So let's jump to the next page, Mark. Okay. So here we just have, again, is I'll leave you to take a closer look at this on your own, because I do want to jump into some of the estate tax side and some of the additional proposals about exemptions, rates, and so on. So why don't we jump on to the next page? Okay, probably if there was a PowerPoint school, they would probably, on the first day of the first lesson, said, don't make a slide so cluttered with lots of information and both narrative and lots of numbers on here. In any event, I think a lot of this is just a little bit of history for you, that we had lower exemptions and they have increased over time. If you actually look back even further, back to 2001, the exemptions were really much lower. I think somewhere in the $600,000 range. The rates were higher, but we've seen a steady increase. I wouldn't say a steady, but it was steady at one point, and then it jumped significantly. The increase in the exemption, the decrease in the rate, and lo and behold, we have 99.9% of people no longer subject to the estate tax. Obviously, in 2025, that all comes to an end, or at least the exemption is significantly modified, and that is it's cut in half because of the way the current laws sunset. That's the Tax Cuts and Jobs Act sunset at the end of 2025, returning it back to the law that were in effect prior to then. So that would be a $5 million exemption increase for inflation that we would expect to be somewhere in the $6.5 million range. So the proposal that Biden is suggesting, and it really is not a specific proposal, and it wasn't in his main tax proposal. It came on kind of somewhat a little bit later on in October, I believe, of this past year, when he just made a mention of returning estate tax parameters to 2009 kind of assumption. So let's think about 2009. What did we actually have? We had an estate tax exemption at that point in time of $3.5 million, which was not indexed for inflation. We had a gift tax exemption of $1 million, and we had an estate tax rate of 45%. So that would significantly expand the number of people that would be subject to the tax. Nonetheless, it still would be a highly progressive tax. So if we do see changes of this nature, and Mark, we can go on to one more page. If we do see changes of this nature, it kind of raises the question immediately, which is what we are getting from clients is really, what should I be doing about this? But what we really want them focused on is what is at stake here. So let's think about an 11.7 million exemption where we are right now. And if that drops to 3.5 million exemption, there'll be a loss of 8.2 million. So that's 8.2 million of assets that could be sheltered by the exemption, but would no longer be. So to figure out what is really at stake here, you could either multiply that by 40% and you come up with just about $3.3 million of additional estate tax for those who have a significant estates that could otherwise be sheltered by that amount, by the greater amount of an exemption. But earlier I just said if we return to 2009 parameters, we're looking at a 45% tax, and now we're looking at a potential cost here of about 3.7 million. So a significant amount is at stake, which is really driving the question is, what should I do about that? And that's where we are seeing a lot of planning that occurred at the end of last year that has continued on for this year. I'm going to advance one more page here. It's okay. If you scroll one more time, I think, yep. Let's go a couple more times until we get to the full page here with everything on here. So this is coming up as a kind of a fancy graphic, but we'll just leave it on that. So you can see here, just by way of illustration, is that if the exemption were to decrease, obviously, you know that there's a lot. It's kind of, it would feel more like a giant annual exclusion gift between now and, let's just say, if the changes took effect at the beginning of next year, then this year, that additional exemption would feel like a giant annual exclusion gift, which would be use it or lose it. So for those of you and your clients who do want to use it, is the first trap that many people fall into is they say, well, if I were to use that 8.2 million of exemption that is otherwise going to disappear, or we believe that would disappear at some point in time, then I could extract a significant estate tax savings. But you could actually do even better. And the reason is that the use of the exemption comes off the bottom and not off the top. And when I say off the bottom, if you think about this visually, what aligns on this page here, if you think about the existing exemption, think about that as the base exemption, think about what was increased over the last several years as a bonus exemption. And in order to use the bonus exemption, you first have to use the base exemption. That's the way just the exemption is calculated and determined ultimately upon death. So if somebody said, I'm going to use 8.2 million of the exemption that was otherwise disappear by next year, what they really have done is they have used only 8.2 of their 11.7 million exemption. Because come next year, let's assume that the exemption is 3.5 million. You say that is the available exemption, and you say, how much have I previously used? And the answer is, I've used all of it because I used 8.2, thereby being no available exemption in 2022. Okay, so only 8.2 million was used. Let's say somebody says, well, I'm not comfortable making a gift of 11.2 million. I just am going to use only 3.5 million of exemption in this current year. They go ahead, they make a gift of that amount. And again, we'll roll forward to next year in 2022. Let's say the exemption decreases to 3.5 million. That's the available exemption. You say, how much has previously been used? The answer is 3.2 million of exemption was used, thereby leaving that taxpayer with no additional available exemption. Okay, so that's why it's important, if you're going to go, you got to go big on this. Or I will give you kind of a rule of thumb. It doesn't make any sense to make any taxable gift unless your gift is going to exceed what you believe would be the projected exemption for next year. Again, whether I stated exactly the same or otherwise, it doesn't make any sense to make a taxable gift this year unless you're going to make a gift of an amount that you believe will exceed the exemption that is available next year. Otherwise, you simply use it. Okay, so let's move on. Let me also talk about another problem that we oftentimes see, and that is with gift splitting. So the gift splitting is one of the advantages of gift splitting is that it can use both spouses' exemption. But what we see in this environment is oftentimes doesn't make sense to use any of the exemption. So let's just take let's just round the numbers up, and let's assume if the exemption was $12 million and you wanted to make a 12 million, let's assume that the wife was making a $12 million exemption. If they split that gift, then husband and wife are each considered to make a gift of $6 million. And as I mentioned to you earlier, by next year, they would then have no available exemption to them, because next year's exemption, let's assume 3.5 million, they've used 6 million of exemption, and nothing is now available in terms of extra exemption. So by splitting a gift, they have availed themselves of 12 million of exemption. If they don't split their gift, then the wife would have been able to use the full 12 million exemption. Again, I'm rounding up. I know the exemption is 11.7 million. So the wife would have used her full 12 million exemption, and the husband would still has 3.5 million exemption available. So they would collectively, they would have more available exemption to use. And that's why we are oftentimes advising our clients not to split the gifts unless they are planning on making very significant gifts, actually the full exemption between the two of them. Okay, so generally, as you go through this and you realize the significant savings that can be achieved, the next question is, well, what do I have? What I'd like to take advantage of this is, what kind of assets can I give? And usually our clients are looking at this from a perspective is, what am I not going to miss? Do I have art? Can I give a piece of my residence? Is there some other asset that maybe is not producing income that I would not miss on a day-to-day basis? In other words, what they're trying to tell us is, I'd rather not give my marketable securities. Is there something else that I can give? There's some clients even want to borrow money from a third party, make a gift into a trust, perhaps even borrow that back out or substitute that for a promissory note and pay back the loan. So we have seen all sorts of possibilities here to preserve flexibility. But the primary means of preserving flexibility is really of choosing how that gift is made. So gifts don't need to be made vertically. In other words, they don't need to go down the generation. Gifts can be made on a lateral basis. They can go across the generation. And when I think across the generation, I think that you probably think of the same, and that is from one spouse to another spouse, so long as the gift is not included in the other spouse's estate. In other words, what we call spousal lifetime access trusts. Okay, that is for those, I'm sure that you are aware, there's no such thing as that trust. That is just a descriptive term for saying any trust that possibly provides for discretionary or even mandatory distributions to a spouse can be, kind of tagged with that name. So that's probably where we're seeing about 95% of the gifting made. Okay, let me talk for a moment a little bit about a possible effective date for this change. Is the first, there's a bit of a concern that if Congress doesn't draft legislation in a very appropriate and specific manner, that by accident they can have a retroactive effective date. And retroactive, that is to the beginning of the year, which can be quite punitive, or actually would be very punitive for people who have made gifts this year. The reason being is there is a gift tax provision, 2505, that says the exemption that is available for you for gift tax purposes is the exemption that is in effect on the very last day of the year. So you can make a gift today. The exemption is currently 11.7 million. But if Congress enacts legislation, let's say in August, maybe September of this year, and they say that legislation, as of August, the new exemption would be 3.5 million. Unless they draft that really very specifically, that would mean that on the last day of this calendar year, there would be a $3.5 million exemption. And according to section 2505, it said whatever exemption is available on the last day of the year is the exemption that is available for the entire year for gift tax purposes. So I'm not too worried about this. I think that Congress will be aware of this, but there are some practitioners that are a bit kind of a bit worried that even Congress trying to do something on a prospective basis may actually come back and hurt some taxpayers. Nonetheless, I think it's probably more likely that we would see these changes on a prospective basis. We've heard some commentary from Secretary of the Treasury, Janet Yellen. We've heard some other commentary from another Biden appointee at Treasury, where they do prefer a prospective effective date. And for estate tax purposes, I can tell you, we have seen retroactive changes in estate tax rates, but we have never seen a retroactive change in the exemption. We've never seen a retroactive change that decreases the exemption, and that's simply because there hasn't been any. But I think it would be punitive and unfair, and I can think of a couple of other adjectives, to actually have a retroactive effective date for an estate tax exemption for many of the taxpayers that have relied on the current law. It is not outrageous to think of a prospective from the date of introduction of legislation or even the date of passage of legislation. And that is quite common when it comes to capital gains. And we'll talk about that in a moment. Okay, let me jump on to another category that we call artificial gifts. Earlier, I mentioned is that there's lots of people that say, okay, if I understand what's at stake, these are some real dollars here. I'd like to actually make a gift, but I'm not quite either sure if I have assets available to me, or are there ways of me making a gift that kind of what we termed artificial gifts, that they use the exemption, but you really haven't given away those assets. One of which, and we can provide a copy of this, is we do have a report that we have issued that discusses the use of self-created promissory notes. That I would say exercise extreme caution in this area. Not all states would recognize that those are actually valid promises. The IRS has said so long as the state recognizes that it is a valid promise, a self-created promissory note. What we're talking about here is not issuing a promissory note in return for a purchase or a swapping of assets, but rather just a truly self-created promissory note. I write down on a piece of paper, I promise to give you $11.5 million upon your request. And I hand that paper over to you. Is that a valid and enforceable gift? The IRS has said in rulings, yes, that is, but again, it is based on state law. Another way of making an artificial gift is perhaps creating something. Let's think about this in the context of other common estate planning, let's say such as a GRAT. A GRAT is usually you put assets into the GRAT, you retained an annuity. Let's assume that annuity is for 2 years. That annuity will have a value to it, and therefore the taxable value of the gift in the GRAT is zero. But let's just say you put a provision in that GRAT that is not allowed, that makes that GRAT invalid. Let's say you could commute the value of the GRAT at any point in time. Or let's say you provide that annuity is not truly structured as a qualified annuity. In that case, it's no longer a qualified interest, and everything you put into the GRAT is considered to be a gift because what you have retained is valued at zero. So if one puts $11.5 million into the GRAT, that GRAT is considered to be a gift of $11.5 million. If that GRAT is a long-term GRAT and you die during the term of the GRAT, everything is back in your estate, but nonetheless, you still have made a gift when you created that GRAT. Think of a Cupid, think of a grid and other strategies that you can do the same thing with. All you're doing is just you are purposefully running afoul of gift tax rules, which normally nobody would ever think of doing. But here, that actually trigger a gift, transfer the money away to a third party yet. So that could possibly, and I say could possibly, be another avenue for those who don't have the ability to give away these assets. This was actually brought to the attention of the Treasury when they issued their clawback rules. rules. And they said that people can create artificial gifts to use their exemption, and perhaps that may not be fair. Treasury responded is that we could issue regulations addressing that in an anti-abuse rule, but right now that they are outside the scope of the regulations regarding clawback. So that chapter is not yet finished. Some people do ask us about that, so I would say exercise some caution. Probably the most common way of kind of having your cake and eat it is another category of what we call reversible gifts. Let me just quickly touch on that. A reversible gift is something that where you can make a decision on how you want to treat that gift. You make the gift now, you just make a decision on how you want to treat that gift in the future, or you have the possibility of unwinding that gift down the road. So think of a Q-tippable trust, simply a trust for the benefit of a spouse that qualifies for the marital deduction. You put the gift into the trust, and you'll get until, if you extend your income tax return, that'll also extend your gift tax return, and you will have until October 15 of 2022 to decide whether or not you want that gift to be treated as a marital gift, in which case it's not a taxable gift, you haven't used any exemption, or to actually have it treated as a taxable gift, which would fully use or use your exemption to the extent of the gift. The reason somebody may want to hedge themselves is they may want to see, how does the legislation play out? Are we going to have a decrease in the exemption only to a certain amount, or maybe Congress kind of punts on this and focuses on some other matter? So it's really a way of having your cake and eat it too. And the runway here is long enough to determine, hopefully, that Congress will have determined what they are doing on tax issues, certainly by then. Another way of doing this is a gift that's subject to a disclaimer. Let's say you make a gift in trust and you put some provisions in there that would allow whether it's a particular beneficiary or the trustee to disclaim. Unfortunately, that long runway is quite shorter. That is only 9 months from the date of gift, but that will give the recipient at least an opportunity to decide. There's some issues associated with that, but nonetheless, a disclaimer is nonetheless a valid tax provision that can change the result of an otherwise taxable gift. So hopefully Congress will get around to this and we'll know what the lay of the land is within 9 months. If not, a decision about disclaiming would nonetheless need to be made in 9 months. The other that we have heard that being used, but probably the least amount, is a formula gift, is describing the gift. I'm making a gift of the largest amount that can pass pursuant to the federal exemption to a particular trust, and the excess amount goes into some other trust. The problem with this is that if Congress does something and it is retroactive, which is the reason that some people may want to address this being pursuant to a formula, thinking that whatever goes into a gift trust, that would be a taxable gift, is only the amount of whatever available exemption, just in case Congress makes a retroactive change, which I would doubt nonetheless. But there are some concerns around this, because if Congress does make a retroactive change, isn't that formula change itself? And wouldn't that apply is that at that time, if you read the formula, your available exemption is some different amount than what you would have thought. So a couple of problems associated with that. So why don't we move into, I want to kind of bring our attention a bit, and then I want to see if we'll have time, maybe talk a little bit about reconciliation and how these changes can get done. But earlier I showed you a slide. There were lots of income tax changes on the slide. I just want to really shift gears and get over to the income tax side. So Mark, maybe if we can advance the slide one more time. Okay, so this, I think it just kind of sums up, I'd say, a lot of the planning that we're seeing here is one size fits all answers are at best overly simplistic and oftentimes incorrect when it comes to lots of income tax planning. And I want to go through an example on capital gains in a moment. But if we can go to the next page. So this page and the next few pages is why I didn't spend any time on the very first slide that we summarized some of the income tax changes, because we're going to do them right here. Okay, so on the income tax side, is one of the main changes is to bring up the top tax rate from 37% to 39.6%. It is unclear on where that cutoff would be, and I'm not even going to fathom a guess on here. It's currently, you hit the top 37% rate at somewhere 600 plus of income. That 39.6% rate could possibly be at that break point, or it could be at a lower break point. Nonetheless, it could affect some other brackets below that, but that is the proposal, is to bring that up, which is very targeted for top income tax earners, which is why it is so attractive, really from a Democratic perspective. And that also addresses lots of the social injustice issues, which is income and wealth equality, which you'll hear a lot of these other changes, including the estate tax changes, are much more targeted to. On the deduction side, it's not only would deductions possibly be expanded a bit, but they would also be narrowed at that same time. So expanded in terms of a class of a greater amount of items that could be deducted, but the value of those deductions would be narrowed in two respects. One, they would bring back the PEAS adjustment, which would phase out itemized deductions for high income earners, high income defined as those earning over 400,000. And then secondly is to limit the value of those deductions as if the taxpayer were in a 28% tax bracket. So a little bit stealthy there, a stealthy tax increase in both respects. In terms of effective date, is again, we do think that Congress gets around to looking at this legislation after they get through kind of the next round of COVID stimulus, whether you want to call that the CARES Act 3.0 or the stimulus 6.0. In either case, that needs to get out of the way, and then Congress will focus on actually the Biden's broader infrastructure and spending agenda. Biden does not have a tax agenda, unlike President Trump, which was out of the gate, wanted to enact tax reform. Biden doesn't want to enact tax reform. He wants to enact various policy changes that require a fair amount of spending, which would require a fair amount of revenue to help offset that. And that's where those tax increases will come from. So in terms of effective date, I can tell you is that it is not uncommon for income tax changes to be done on a retroactive basis. We've seen that back in the late 60s. We've seen that back in 1993. And it's just a very clean and easy way of kind of cutting off. We're all on calendar years as individual income taxpayers. People earn wages. It's not a surprise that somebody's not going to say, I'm not going to earn wages. It may be different when it comes to capital gains, but at least for income taxes, I would not be surprised if there was a retroactive. I'm not saying that that is the likely case. The likely case is a prospective change. Even though revenue is needed to enact some of the spending policies, it is more likely that we would see this as a prospective change. Okay, let's go on to the next slide. I'll talk a little bit about capital gains and the changes here. This is probably one of the most dramatic ones, and also targeted really, if you think about income and wealth inequality, this is the one that addresses a significant amount of that because it is targeted to taxpayers earning greater than $1 million. I'm sure you're all aware, capital gains, long-term capital gains and qualified dividends would go up to ordinary income tax rate. In other words, there would not be a preferential rate associated with this. If there were a compromise, and I think that for some Democratic members, I think that this even is a particular struggle to get up to a rate this high, even though there are some very highly influential. For instance, the chair of the Senate Finance Committee has long proposed changes in line with this. But for some, this might be a little bit too far. And so we're thinking perhaps a compromise rate of around 28%. Why 28%? Well, the Joint Committee on Taxation has done studies in the past, and they have believed that really is kind of the maximizing rate for capital gains. If you have rates higher than that, that may produce what's called a lock-in effect, where some people just simply don't sell. But that rate could inch up higher so long as they address the step up in basis. Because again, if you think about the lock-in effect, why are people locking in capital gains? Only to hold them until death, in which case they receive a step up in basis. So if the step up in basis goes away, then this maximizing rate of 28% perhaps can creep a little bit higher. But we think 28% might be an area where there is some room for a compromise around these rates. In terms of effective date, if we think back to in 1997, there was a capital gains rate change, and that was done in the roughly around the middle of the year. I believe it was July, but the bill that introduced that change, I believe, was introduced in May, and therefore the capital gain rate change was effective in May. So they don't need to pick a clean beginning of year or end of year change for a capital gain rate. But rather have it, they can do a mid-year change. And there's other reasons for a mid-year change. It also changes or doesn't skew taxpayer behavior. If you could even think back just a couple of years ago when there was an expensing provision for 100% expensing for the Trump tax reform, that was effective before all the other provisions in the tax bill was effective. It was effective essentially when they first introduced that provision in September of 2017, because they didn't want taxpayers, particularly businesses, to say, okay, in that case, we're going to hold off on any purchases of capital items until the following year. So the same thing with capital gains, is they really don't want to skew behavior. So it could quite possibly take place on an effective date. All right, I'm going to go real quick on the next page. Is payroll taxes. This is really I'd say it's a bit of a shocker, because the amount of the tax increase that could be done here is, as you know, is FICA taxes capped out at $142,800. The proposal here is to reinstate that, okay, have a donut hole. So in other words, no FICA taxes, or no 6.2% portion of that after you hit that cap up to $400,000, and then reinstate that. This introduces, or actually is projected to raise a huge amount of revenue between the employer and the employee share, over $800 billion over a 10-year budget window. So this is really kind of needed to get some of those other spending priorities in line, or to make this a little bit more deficit neutral, if I call it that. But I don't think that this gets done. The reason being is this. Tax changes are likely going to be part of a big spending bill that is likely going to have to be pursued by way of a budget reconciliation action. One of the rules around budget reconciliation is you cannot change Social Security or payroll taxes. This is payroll taxes, so it cannot be pursued by way of budget reconciliation, or actually, I should say it another way, it is objectionable if it is. It can be included if nobody objects to it as a point of order. So this is a real challenge to implement this one. So let's move on. I wanted to very briefly talk to you about some of the decisions around, in terms of planning, in terms of capital gain, some things for you to think about. There's a couple of charts on the next pages, but let me just go through a quick example, because I do want to open it up to questions fairly soon. So on the capital gain side is you and your clients are going to be confronted with the following issue, which we have seen a tremendous interest in, is what should I do? If I think capital gain rates are going up, maybe up to nearly 40% between, before that, the additional surtax, or maybe even up to 28%, does it make sense to sell an asset before the imposition of those higher tax rates? Well, the answer is it's actually very simple arithmetic. Maybe if I wanted to make it more complicated, I'd say it's very simple algebra, but it is pretty simple arithmetic. And it's a weighing of two choices. It's a weighing that if you were to sell now, you would be able to capture the lower capital gain rate, but you'd have to pay income taxes or capital gains tax earlier, and you would lose all that money because that's what goes over to the government, and you would be left with a lesser amount of money to reinvest. And let's just assume you're going to reinvest in the very same stock. There's no problem with that. There's no wash sale rules for gain. So that's the one comparison. And you have to compare it to something else. Instead, let's say you let it ride and you said, I like the investment. I don't want to give up some of the assets and pay a tax any earlier than I have to. I'll let it all ride, only to pay a higher capital gains tax in the future. So we go through this, an example of this here, and we look at a very simple example that if your time horizon was only 1 year, you were given a choice, sell something now in this calendar year or sell something 1 year from now at an 8% return, you would be better. We assume that there was no basis in this asset. Even if there was a higher basis, the answer is going to come out the same, is that you would be better off selling the asset this year and even buying it back, okay, rather than holding on to that asset if you would otherwise have sold it next year. Mark, if we go on to the next slide, I think this is a little bit more easily communicated in a chart. If you look at the kind of the bar chart, and you look at the bar on the far left, is that we depict is the blue is what would you have, what would that taxpayer have after taxes now versus what would that taxpayer have after taxes if they sold it next year. And when I say now, I mean, what would they have now if they sold it, paid the government their taxes, reinvested it into the same stock, and roll that forward 1 year from now. So we want the time frame to remain the same. So it's an apples to apples comparison. But you'll see, as the time goes on, if the taxpayer said, well, my time horizon wasn't 1 year, instead, let me look out a couple of years out. It was 2 years out. You can see that the gap then starts to narrow. And if you can see, we go all the way out to roughly 10 years or so. You'll see it's relatively break even. So let's go flip to the next page. And so what I'm bringing you to the conclusion is that there's two primary factors that is driving this decision of the sell now versus sell later. And one is time horizon and the other is hypothetical investment return. So long as you lock down one, you can just simply solve for the other, okay? So let's take a look at this side on the left side of the page. For any given time period and any assumed tax rate, okay, we're assuming here roughly a 40% tax rate, one could calculate the break-even annualized investment return needed to make the investor whole. So in that example that I just gave you, and I said an 8% return, you would be worse off. So maybe you're curious, well, what would make you indifferent between selling now or selling next year if next year had a higher tax rate? And the answer is 145% return. So your reaction is, whoa, where am I going to find 145% return other than perhaps in GameStop or a couple of other companies that could have that actual return in a day, either up or down. But it goes to illustrate is sometimes investors could understand these decisions by understanding what kind of investment return would they need to break through the headwinds of a higher income tax rate. And I think that this is very helpful. Or sometimes investors understand this through a little bit different lens. And let's look on the lower right-hand side here. In this case here is we are locking down the investment return. And somebody may say, listen, I don't know, but I think it's reasonable that my portfolio or my particular investments may have a 7 or 9% return. And you can turn that into a break-even time horizon, and you'll see that here. So what the conclusion here is that these are really a headwind of a 40% capital gains tax is so severe that the time horizon is quite significant. Let's turn to the next page, and I'll summarize this. I summarize this both at the proposed capital gains rates, which I say is, I kind of shorthand is 40% with the surtax, it's more like 43%, or perhaps if we saw a 28% increase in capital gains, which converts into 31.8% with the surtax. I look at both based on various investment returns, what kind of time horizon would you need for that investment to break even? And again, this helps some people that says, well, listen, I'll sell earlier than that. If we go on to, why don't we skip the next page for a moment? This is just illustrated in a graph. One more graph is there's a little bit more sensitivity around this, that if we saw different tax rates, it will change the time horizon on holding period. Why don't we go one more page, because I want to bring you everything I said. You may say, well, that's all well and good, but let me give you, and before you rush out and say, well, I'm going to advise clients to sell, or I'm going to even sell, and I remind clients of this all the time, is careful. That's not what we're advocating here. But keep in mind the following is I just call this what goes up must come down. I don't know, but it's happened before. So I think I'm comfortable making that statement, even though it does have a question mark associated with it. The point is capital gains rates change over time. Just because they potentially could go up to over 40% at some point. There could be a new administration. They may have a different view of what capital gains rates should be. That's one. Perhaps we continue to see a step up in basis, or step up in basis to some extent. And somebody may want to hold on to an asset. There could be a whole host of reasons, and probably one that is near and dear to so many of us here is charitable gifts, whether it's a gift to the community foundation, whether it's a gift to elsewhere, is charitable gifts are important. And so I'd say don't throw the baby out with the bathwater, is that if there's embedded capital gain in there, one very easy way of getting rid of that capital gain is to contribute the asset to a charitable recipient, such as the foundation. Okay, let me, I'm going to skip the, well, I'm going to comment on the next page just for a minute, because I do want to bring this to a conclusion and see what's on your mind. Is earlier I mentioned that the 28% or that itemized deductions could be restored. And kind of a knee-jerk reaction to many is that, well, if tax rates increase, would my charitable deduction be worth more to me in a higher tax rate environment than a lower tax rate environment? And the answer is generally yes. But one of the proposals is to limit the benefit of itemized deductions to no greater than 28%. Now, who knows what they can do about charitable deductions? Usually charitable deductions, mortgage deductions are kind of like sacrosanct and kind of in a special category unto themselves, and sometimes immune to certain other rules. There could be political pressure to leave them aside from a 28% kind of tax benefit. But essentially what we're looking at this chart here is that what is the benefit of a charitable deduction at both a 37% tax rate or under a future tax regime that could be, I mean, you can guess probably as well as I could guess here. Does it mean it's 39.6%, which would provide a 7% benefit over a deduction today? So that's saying hold off on your charitable deduction to next year if you want to maximize the tax benefit. Or if we see that those benefits or that deduction, an itemized deduction such as charitable gifts, is limited to a 28%, that actually then results in a 24% detriment compared to current law. So that would argue just the opposite, accelerate your charitable gifts to the community foundation or otherwise. Okay. The last point I want to make is on opportunity zones, which is another way for those, and actually a question just came to me this morning about this, and that is a question about opportunity zones and the ability to defer gains into a future environment. And one concern that we had, even before we knew that Biden was elected, is what happens down the road in the future. Income, cap gains rates can go up and down, and because you're deferring the capital gain into 2026, what would that gain environment look like? And if it was higher than it today, could taxpayers get whipsawed? And their original gain that they deferred at 20% is only, they wake up in 2026 only to find out that the gain is minimized to 90% of the gain, but is subject to a much, much higher tax rate. And I say that is a big problem, but it is fairly easy to do the math around that, is what kind of return that you would need. But I would also say to taxpayers is don't lose sight of kind of the golden egg that's out there of what opportunity zones or the tax benefit from opportunity zones. The real winner could be is that any future appreciation in an opportunity zone investment would be free of any income tax. So even though the initial gain that you had gets reduced somewhat, but could be exposed to a much higher capital gain rate, is that if the future appreciation is significant, that nonetheless could be subject to no capital gains rate. So I think it's a mathematical analysis, but I would see is the knee-jerk reaction or the kind of the simple answer that many people have is say that's not necessarily so. I can think of lots of different examples where they are of a very significant value. So I know there's a lot to cover here. I know I do want to turn it over to Kurt. I know that there may be some things on your mind. So why don't we open it up for questions for a bit. Kurt?
Mitch, terrific presentation. Everybody, just a reminder, you have a Q&A button on the bottom of your screen. Please click there to submit questions. I do have a couple that came in, Mitch. The first one is, do you view COVID as somewhat of an opportunity in the realm of claiming valuation discounts because of the uncertainty that COVID places on the viability of businesses and the behavior of consumers?
Yeah, that question started coming up, I'd say almost a year ago, and that there were a number of valuation firms that had issued kind of white papers on the topic, and I defer to their thinking around it, but the conclusion was generally yes. But it was also generally yes in a much more targeted sense. Restaurants and other businesses that depend on the public and having the public come to them, the headwinds were, the challenges in this environment and the outlook, even if relatively short term, is what I was hearing from valuation companies is yes, they had a material effect on the valuation of those businesses. But we can turn it again the other way. Let's say the tech companies, let's say a developing tech company, there's lots of other companies that have thrived, Amazon and web-based companies, that I think evaluation experts would probably tell you is that their multiples probably could be even higher. So I would say maybe the long and short answer of it is probably a mixed bag, but I think that you are right on target. I think there's a significant amount of businesses that are having very significant challenges, and I think the evaluation experts would be wonderful people to contact here.
Okay. I have another question. It's in the realm of forecasting. So, which is, what do you see in the future? What does your crystal ball say about portability staying with us?
Yeah, we have. We kind of look back. I guess we look back to look forward. And in other instances, we see when there were proposed changes. And I think when I say proposed changes, what I mean is there have been numerous bills that have been introduced by a number of different Democratic House members or Senate members to whether it's to adjust the rate, adjust the exemption, do away with, making grantor trust includable back in your estate, number of things, but none of them have addressed portability, or none of them would have pulled away portability from a taxpayer. So I would say my view is that's here to stay. I have not heard anything that would change in that area.
Okay. This questioner says, notes that you mentioned value adjustment clauses, and that one of the issues there is that wondering if you could address, how do you handle K1s between the trust and the donor when you have a value adjustment or formula clause?
Wow.
There may be there's some question as to who is the owner of
Yeah. That is a it's a difficult question to answer only because it is a difficult it's a difficult issue. And so let's just say, let me give you kind of a real quick example is you have a formula provision that says I give my remaining exemption in effect on today's date to a trust that does not qualify for the marital deduction, okay, taxable gift. I give any excess to a Q-tip trust that qualifies for the marital deduction. As we know, that Q-tip trust says the income must be paid to the taxpayer at least annually. Okay, so I make that gift. Congress makes, some changes. They do this in, I don't know, they put everybody on notice that they're going to make, these changes, but they don't make them until a certain time and they have a retroactive effect, but maybe that's on the other side of the end of 2021. And so you have a situation where the marital trust says you have to pay the income, but you don't know what's in the marital trust. So the answer is, I don't know how that gets addressed other than through appropriate planning, and people are concerned about that. So sometimes I have been seeing is where the excess of the waterfall over the exemption amount does not fall into a trust that potentially could really cause significant problems. There are other problems because you still need to determine the K-1 income, but I think it's a legitimate issue that needs to be really thought through on the drafting side. I don't think many people are fully thinking it through.
Yeah, good point about the spillover.
Yeah.
Considering that carefully. This next questioner, and this may be our last question, but go ahead and fire off some more, folks. We have about a minute or two left. But this next questioner makes a point saying that these various techniques, the value adjustment clauses, the possibility of using disclaimer planning, seems to really put the discounting associated with COVID potentially really seems to put a premium on the gift tax return and careful preparation of the gift tax return and collaborating between the CPA and the attorney in the preparation of that return. For example, you just mentioned a spillover trust. That trust instrument perhaps, would need to be attached to the return just as a, so I think this questioner makes a good point.
Yes, I was going to say, I think that's more of a statement, and my
Yeah.
response would be, I completely agree with that. I think that there's great opportunity. One of the other opportunities is that there's others with different disciplines, accounting law and others, that you need to, these gifts are so significant in this, or potentially so significant, is that you need to look at the impact, not just today, but in the future or down the road. We were working with somebody who's going to be making a significant gift. They also had a very significant amount of assets, but because their runway was so long, they were young enough where their gift was going over to a grantor trust. That grantor trust would grow free of any income taxes. The taxes would be borne by the grantor. Essentially creates a trust that grows tax-free over year after year after year. And if you don't look at that, what that trust can grow to in 5, 10, 15, 20, 25 years that's a big mistake. And so there's lots of others, people with different disciplines that can crunch those numbers. What we ended up seeing is that is going to cause an incredible amount of stress on the grantor's other assets, and we didn't believe that there was enough liquidity. So it all comes back to, to me, is teamwork. Is you got to think of some of the escape hatches as you're drafting some of these documents, but these are significant gifts that are going to have potential cash flow issues for the gift giver, potentially down the road. Excellent.
Well, Mitch, I think we've reached the end of our time. I want to thank you for a terrific presentation, very thought-provoking, and you've addressed some questions that I'm sure are on the minds of many of us attending today. Penelope, thank you very much for your role in bringing Mitch to us. Our reminder that February 10th, up in just a week or so, is the Legacy Luncheon for Legacy Society members of the Community Foundation, as well as PAC members. So all of you should have already received an invitation to the lunch. If you have not, please contact Mark Kotler at the Community Foundation, and we'll be sure that you receive an invite. It will be, of course, a virtual event. Hopefully next year we'll be in person, but and the speaker is our local author, Brad Meltzer. So then our next PAC meeting is the Highlight of Heckerling presentation that we do annually, and that's on May 25th at noon. Please invite a friend, a colleague, a fellow professional advisor to come along to that one. That's where we make an effort, as I mentioned, to broaden our PAC. That's where we make an effort to invite friends. And then lastly, I just want to wrap up with a quick thank you. Mitchell, Penelope, again, great job. We see, how great to be a client of yours and to have the benefit of that advice. So thank you so much. Thank you everyone who has attended. Wish you all the best. I'm going to sign off and close out the meeting here. Thank you, everyone.
Thank you.